Mark Twain's dry sense of humor is illustrated in our opening quote. Investors are compensated for risk, and without it, there would be no reward. As Mr. Twain suggests, risk is ever present, but history shows us that seasonally, some months are worse than others. The current financial media focus is on the possibility of a September swoon. As always, there are a host of concerns weighing on the market, from trade and emerging market concerns to midterms and social unrest. Could these concerns further reduce returns in a seasonally weak month? The answer, as always, is yes, as the probability of a decline is never zero. Our question is about the longer-term probabilities for continuation of the bullish trend. Short-term thinking rarely leads to long-term gains. First, we'll look at a summary of this week's economic data and interpretation. This week's economic data continued to show record economic strength, while housing remains a soft spot, but is showing some signs of improvement. We continued to set records, with unemployment claims dropping to the lowest level since 1969. The unemployment rate dropped to a generational low, and average hourly earnings reached the highest level since 2009. Business is humming, jobs are plentiful, and workers are realizing their first significant wage increases in almost 10 years. It's also reassuring that memories of 2008 are still fresh, and we're not seeing signs of euphoric investor sentiment. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. The market was closed on Monday for the Labor Day holiday. On Tuesday, dollar strength on the back of strong economic reports weighed on stocks in both the U.S. and emerging markets. On Wednesday, several tech giants, minus Google, appeared for congressional testimony and faced the prospect of regulation, which weighed on tech shares. On Thursday, stocks continued to sell off on trade and emerging market concerns in the face of continued dollar strength. On Friday, strong jobs report initially weighed on the market, stoking fears of further Fed rate hikes. The market recovered through noon and then fell significantly on comments from President Trump that he might levy an additional $267 billion in tariffs on China. This represents a significant escalation in the trade war without a resolution in sight, and the news was ill-received by the market. The market closed down 1% for the week, and the month and year-to-date statistics are provided at lower right. Now we'll turn our attention to the topic of the September swoon. Why do September and October both have a reputation as weak months? Here's a very good chart by Dimitri Speck showing the monthly seasonality of the S&P. Note that for the past 30 years, September and October have been very weak. We need to think critically about the information we see and ask questions. Would we see the same seasonal weakness over a longer time period? We know that averages can be misleading and skewed by significant outliers. Could the seasonality be muted or exacerbated by bull or bear market regimes? Let's look at some of these factors and their impact on September seasonality. This slide shows September and rest of year returns under various market regimes. This is excellent research. Unfortunately, I don't recall the source for attribution. The takeaway is that significant outliers during bear markets skew September seasonal returns. When the market is rising, like it is this year, returns are still low relative to other months, but not disastrous, like significantly negative returns in the next two columns that we see during down years. Looking at price behavior during similar periods gives us a much more precise assessment of probabilities versus using averages. With the first shortened week of September in the books, let's look at a daily chart of the S&P. This is a very near-term outlook, and our focus very much remains long-term. The left-hand side of the chart shows the start of the correction, and to show how the trend regained strength during the recovery, let's look at where price found support as the correction progressed. Dropping back to the 200-day moving average is a significant correction in price. Early in the correction, the market found support several times at the 200-day moving average, which is shown in green. The 200-day moving average is a good indicator of the long-term trend and had a positive slope, which indicated a higher probability of a favorable resolution. As the recovery progressed, the slope of the 50-day moving average, shown in red, turned positive, and price tested the 50-day moving average and also found support. As the trend strengthens, we find support at higher and higher moving averages. Recently, we've found support at the 20-day moving average. As of 11:30 a.m. on Friday, we've bounced off of the 20-day moving average again. Notice the rising channel that we've been in. We tried to break out of the channel to the upside and have come back in. Could we go to the bottom of the rising channel? Of course, it's always possible, though there are several areas of potential support that make that a lower probability outcome. The top of the consolidation is a support area, and it's not uncommon for this area to be tested. Below that is a rising 50-day moving average, again shown in red. All of these signs point to short-term seasonal weakness and volatility without a catalyst to move the market higher. Escalation of the trade war would certainly be a catalyst that would move us further to the downside, but thus far we see no evidence of a market-crashing September swoon. This chart is from last week's video. This is a weekly chart of the S&P 500 ETF and shows the two most recent periods of consolidation in the gold boxes, along with moving averages to help visualize the trend. We noted that the long-term trend emerged intact, but that a retest of the top of the consolidation would not be at all unusual. We also noted compression of the two fastest moving averages and the start of recovering a fully bullish configuration. Let's look at how the chart has evolved with this week's price action. We had a gap up or rising window last week. Gaps are often tested and filled. As we saw this week, price moved into the gap, but so far has not closed below. News midday today of a significant escalation of tariffs in the trade war with China have resulted in a weak close, which means we have to be open to the possibility of additional downside into next week. In contrast to last week, the fastest moving average in our visualization, the 24-week moving average shown in blue, has now risen back above the 32-week moving average, and the long-term trend continues to strengthen. Short-term volatility is a part of investing and is absolutely necessary for us to be compensated for risk as long-term investors. What helps us navigate to satisfying long-term investment outcomes is our focus on the long-term evidence on the charts and adhering to our disciplined model-based approach. We go into next week with our eyes firmly fixed on the long-term charts and a plan to manage risk. We'll close with some wisdom on the importance of this subject. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.